Okay, so let me just start sharing my screen. Okay, so let me see if I can still see the chat from my window here. Got 13 participants, and I just like to mention to everybody, because I'm sharing my screen, I won't be able to see the chat properly. So if you can, please, unmute yourself and do let me know if anything's confusing or if you have any questions or not. So just doing a little bit of a mic check. Can everybody hear me properly?
Yes.
Okay, thank you. And if in case anybody has any issues with the static or maybe even the video, I will be posting this, the recorded video, so everybody can take a look at this at the end. For anybody who's just showed up right now, you have the sample files which we will be working on the general chat. If not, just ping me in the chat itself, and you'll be able to find the files that you need to work on. There's another question in the chat here. Okay, great. So to begin with, this is a sample notebook that I created for simple analysis of the pricing for a particular commodity. LSTMs, which is one of the main topics that we'll be discussing today, would be short for exactly long short-term memory. And while they may not exactly be seen as advanced compared to the more general kind, the more advanced kinds of algorithms like general adversarial networks or maybe even variational autoencoders, LSTMs are still quite popular for doing normal, you could say predictive analytics for pricing analysis. So the sample file that we'll be looking at today, let me see if I can start to run this properly. And yeah, got that running. Oh, okay. I can see this, some people in the chat who haven't been able to find the files. Can somebody just ping Kareen and Rubaiyat to the post on general if they can? Or wait, let me just do that on my end. Sorry for that, guys.
Like I have a drive link if you're okay with that.
Oh, sure, yeah, that would be fine.
Okay.
Are you going to put up the drive link in the chat?
Yes.
Okay, that would be great. That would be so great. Thank you so much.
Okay.
Okay, while Jaber just puts up the link in the chat for anybody else to use. Continuing on from the previous discussions, yes, so LSTMs, extremely versatile, extremely useful for doing predictive analytics. And the sample file that we'll be looking in today is related to normal pricing metrics from Yahoo Finance. For anybody who's interested in building models for pricing analysis, I would definitely recommend Yahoo Finance because it has a lot of many of the recommended metrics that you would use for these kind of analyses. So once you put up the prices.csv file, which I'm pretty sure you would find from the drive that Jaber has put in, you would be able to then basically specify which exact company you want to focus on. So, I'm just providing some context as to what we're doing here. We have the prices data set. This is the CSV file which you import. And based on the tracking symbol for the company, you can basically segment which prices you want to, take out from this entire data set. Because technically, you have information about, many different companies in the CSV file, which you would get from, any financial website. But we're not analyzing multiple companies. We're just, for now, just focusing on a single company for now. So, and we know that on most stock exchanges, companies, and other kinds of stock indices, they are represented with their symbols. So Yahoo has WHOO. I specified that to the system, and I now have the prices for the company Yahoo set up in a separate data set. I can also take a look at the shape. And if I just wanted to represent how the data looks like, I now have that information as well over here. Perfect. And then we can pretty much expand on to the rest of the stuff. By now, I think it would have been obvious to many people that many machine learning models basically look into creating a training, a testing, and a validation set where you would basically train on the training set and then apply that to the other sets to see exactly how powerful the model is, which is something similar that we're doing here. We split it up 80 to 20%, 80% for testing, training, 20% for testing. These steps are for basically appending and, changing the you could say the portions of the data set into the training and testing sets. And we can also look at the shape of the information here just to confirm that we have exactly what we want. Okay, that's good. Now let's move on to the crux of what the discussion is today. So LSTMs. This is a sample of an LSTM, which is using some specific parameters. Similar to a neural network, which would have activation functions in the middle, you would basically be defining to the system what kind of an activation function you want and how many layers you want the system to be. So, if you're dealing with something more complex, like say audio data or video data, you would be using an extremely dense LSTM. But for now, we're working with normal price metrics, so we can just work on a simple LSTM in this case. I forgot to mention this, but these are the specific packages you would need in the system if you want to run something like this. Keras, most commonly used for normal machine learning, along with TensorFlow if you're doing like real deep learning, and some statistical packages from sklearn and also from SciPy, which we'll be looking at after we're done with the model buildup in this case. The optimizer function and the loss, these again could be specified entirely by the user. And depending upon exactly how you want this to be represented, you could either do this based on the mean square error, which is the MSE in this case, or you could also use the minimum average error, depending upon each iteration. So if I just run this sample and I wait for the system to give me information, you could actually put up the completion time and this is quite important because if you have a data set that's really big and it takes a long time to do the LSTM analysis, it really helps to know exactly, which kind of a network takes more time and which takes less time. So it's good for comparisons. Once I've defined the architecture of the LSTM model, I can simply, run the system and also specify how many epochs I want it to be. So the file that you may have seen from the drive, I've already put up the epochs to be 10, which is quite short. But, I can put up more epochs to this. I can include a bigger batch size if I wanted to. And I can pretty much, change these metrics to make the system much more accurate. I know that's a lot of information for now, so I'm going to give a couple of minutes to everybody to see if there are any questions. Does anybody have any questions?
Yeah, I'm still a little bit confused about the functionality of the dropout function. What does it do exactly?
Oh, you mean the dropout over here?
Yeah.
Oh, so this is actually supposed to be it's actually a stopping metric. So basically what you're saying is if a certain iteration falls below this particular number, ignore that and simply, go off to another one. And the reason you would do this is because you don't want to spend your, machine's resources into creating a model that's not too accurate. So if I wanted this to be more precise, like maybe with no errors at all, I would put this with a dropout of maybe say 0.1 or even 0.005. But that would be pushing the limits of the system. Does that answer your question?
Yeah, thank you very much.
Yeah. And yeah, let's just change the number of epochs in the system and see what happens. Oh, sorry, was there any other question that people had? Okay.
I just want to ask, I just joined in a bit late. I just want to ask about the financial modeling, is it used in as in stock trading, and you could create your own financial modeling to auto trade for you or something, or is
Um,
that for prediction?
well, so that is a really good question. And what I can tell you is, depending upon exactly how powerful your machine is, you can create a model which can predict to a better accuracy than what most financial centers have. And you can actually search for a lot of startups from the Silicon Valley, which you know, startups that basically use quantum computing for this. And the reason they do that is because there are simply too many metrics to measure off and to do time series analysis, but they can do it to such a precise degree that they end up selling this information to other financial centers. So it is possible to, do financial modeling with, the normal metrics you have. And it's again a question of what kind of resources you have to do this. But for the session today, we're just looking at the normal, you could say, models and techniques that could help you in building these kinds of models. So does that answer your question?
Yes, yes. I'll be very happy if at the end of the session we could get some slides or some resources to learn financial modeling. It will be very interesting
That's
for
nice.
some of us who have got a bit of interest in finance.
So I mean, I can share some slides with you, not that I've prepared too many, but and like I've mentioned on the the poster, actually, I will be selecting some people for a free finance book giveaway. So,
We're on top then. On top. I've done a bit of trading, honestly, so it will be very good where we use resistance, RSA, stochastic, and stuff like that
mhm.
to predict, stock direction, so it will be good.
Uh-huh. Well, let's see exactly how the session goes on. And there's a question from Danielle over here. Do you recommend Facebook Profit for price prediction, or is it not widely used in the industry? God, this is a really complicated question because I know a couple of friends and MBA students in finance who do use FB Profit for like normal analysis for their classes, but it's not exactly something you would expect in the real world, honestly. You know, and I think I've actually talked to a couple of people from like consultancy firms from Deloitte and even PwC, and they have their own systems and their own packages that they work with. So some people just aren't too comfortable with using pre-built packages, I guess. Does that answer your question, Daniel? Okay, until we can get a response from that, let's just continue with the analysis. Let me just put it up. It is a 100. Oh, sorry, I need to change that. And let's see exactly what results we can get. So as I change the number of epochs, the system actually gives you information about the value of the losses along with the time steps. Of course, in this case, the time taken to go through each iteration is really, really low because we're just dealing with normal time series data sets. If you were dealing with financial data sets which had multiple columns with many different metrics and dimensions, this would have taken a much longer time. But now we can actually just drag ourselves to the bottom of the page and see what the final loss and the error rate is. So that's quite small. And for a starter, data set like this, it's not too bad. But it's not exactly too good to work with as well. Sorry, was there a question? I heard somebody
Can
unmuted.
I ask a question regarding the loss and optimizer?
Sure, yes, go on.
Yeah, is there other options available? And can you tell me why did you choose loss as MSC and optimizer as RMS prop for this case?
Mhm. So for a much smaller data set, which usually doesn't have too much information to go with, mean square error would be good to sort of see the differences in the error rates between each iteration. And it's pretty much the standard for most calculations that you would see online. There are other optimizers that you can work with, like you mentioned. RMS prop is just one example. You also have the Atom optimizer as well as RELU. and TANH, which is extremely versatile. But again, it's a question of exactly how much resources you have to spend and how much time you have as well. If you read a lot of research papers for like the optimizers themselves, you'll see that something like TANH or RELU, it can be extremely slow in getting the final values for each iteration, and that can make it a little bit less favorable, in the eyes of financial analysts. But it's still an option. We can try that out right now if you want it.
Got it.
Yeah, sorry,
Got it.
did that answer your question?
Yes, got it. Thank you.
Let's just see, and it's a good thing you mentioned, we can actually try this out. So perhaps if I put it as Atom instead. Compilation time, okay. And let's run this once again separately. You can see the difference in the values between the losses between the two cases. So this is from Atom, and this is from RMS proper. And we can actually test this out with TANH as well. And I'm really afraid to do that because I honestly don't know how much time it would take for this. But it's worth a shot. Let's see. Oh, what's this? Unknown optimizer TANH. It's kind of strange. Clearly there's something wrong with the package, I guess. But moving on, I think that provides a bit of context as to how you can simply change optimizers and even the normal losses to, study to see exactly how the different models compare. And again, this is something that you can get to know.
This is helpful.
Yeah.
Yeah.
Perfect. Sorry, just checking the chat to see if there's any questions. And it seems like, okay. Okay, moving on. So once we have the information for these data sets in our system, we can basically, okay, the LSTMs are just one way of looking at this, and we can actually plot the different, the predicted values in this case. So this exact function is what we're doing over here. We are taking in information from the true data sets, we're reshaping it so that we're basically, converting this into a form that would be compatible for analysis. And then we're defining a function to predict the values in the sequence itself. Now, if I just simply run this code, and what I'm getting here is now an example of the predicted values that the system is giving me. And if I just compare that to the actual, data set, it's really close. And this may, bring a bit of optimism to people saying, oh, we've found the perfect algorithm to predict price analysis, but that's only possible because we're working with a really small data set right now. So, it's definitely not as simple as it may seem. But, this is a nice way to get started with things. You can now simply play around with the values in the model functions. You can add more layers into it. You can even change the dimensions if you want, and even play around with different optimizers and see how close the resultant graph matches to the input one to see how accurate your prediction values are. That is a representation of the first part of the session right now. And what we'll be moving into is something much more interesting. And these are the more traditional methods that are used in financial analysis. So I talked previously about Yahoo Finance. You can, you can pretty much install the whole package onto your Python system using Y Finance if you want. And this should give you all the resultant information you need for any of the stock indexes or for any of the other companies. So let's, oh, sorry, I've got a question in the chat. So back down this, but have you used this for stock trading? Is it successful? Okay, Andrew's got a really interesting question. So I wouldn't exactly say I've used this for stock trading, but I have used this like for normal technical analysis. If you ever work for like a venture capital firm, or even for like a normal hedge fund company, for example, you would be doing a lot of analysis to check for the risk of certain companies and indices in the future. That being said, that isn't, see, I'm not going to say that you can't use these kind of analysis to do stock trading, but there's always that amount of risk that goes along with it. And we know, there's never a proper way of saying what's going to happen to the markets tomorrow. That's at least one of the first things you learn in, it's actually a quote from the book from Benjamin Graham, who was seen as a mentor to Warren Buffett, and he wrote the Intelligent Investor, where he compares the stock market to this person who comes to you every single day and gives you a different price for something that he's selling. So it's a really complicated thing. And as Daniel mentioned, I think this works better for investments than for trading, right? That is true, yes. Robo investors and even like the automated AI investors that you find online, they do a lot of normal technical analysis to find the best, stocks for your portfolio. And this is something that people can definitely.
One thing I just want to ask, because of if you use resistance or RSA technical analysis, and if you trading as a scalping, we have fundamental traders as well, where you trade on fundamental news. Will the train algorithm be able to identify like news and also non-farm payroll for US to at least adjust its settings to match up with the trading you're doing or investments?
Mm-hmm. I'm sorry. So, did you have a question regarding this, or?
Yeah. I'm just asking that if you train the algorithm and there's a bit of change in fundamental, if you are a fundamental trader or investment, is the train model able to adjust? To measure up with the fundamental news, at least not to impact or to lose your trade?
I'd say that is possible, but it's again conditional to the fact that you would have to make the model fine tune itself automatically every single time. So that is extremely complicated, because these data sets are being updated every single second with information about stock prices, and the coefficients and the weights also keep adjusting as a result of it. Again, the people who do this are companies with big resources and supercomputers. They can do it because they have the money and the time to conduct these kind of these fine-tuning procedures. So I hope that answers your question.
Yeah, thank you so much.
Mm-hmm. Okay, going forward with what we were saying. Yes, we've installed Yahoo Finance, and we can just specify which particular company we want to focus on. In this case, yf.ticker. This is the command for getting the information from the company. So we're working on a company as a typical standard one, SPY, and we can just run that code to get the information we need from this. Series closing. Now, an important thing to understand is that there's a lot of information that goes into the creation of the data sets. You have information about the stock symbols, the price at which the stock opens when it closes, and also the daily lows and highs of the particular stock we're talking about. Certain financial analyses would only take some of these metrics into account, but more high-end machine learning would have all this information, but represented as a single column. And that has a lot to do with dimensionality reduction, which if we had more time, we would look into it. But I guess we can always talk about that on the chat later on. So yeah, going forward with what we have right now. Yeah, I have the information, and I can specify from the data set itself that I want to only have information from this particular time to this particular time. The reason we're doing this is the same reason as most machine learning projects have this procedure. We are splitting up the information into a training and a testing set. So anything from this particular index would be going to training, anything for that would go into testing. And once we've executed this, we can then basically get the information for the adjacent close points, and also drop any, NaN values, which is quite a common issue with a lot of data sets. And basically, we can then use an autocorrelation function to see exactly how close our prediction is to the actual lags in the days. And yeah, as you can see from the results here. So a better way of interpreting this, autocorrelation functions are basically taking in the price value that you have on a particular day and comparing it to itself on that particular day. It's a really complicated thing to explain in just a short time, but think of it as one time series being compared to itself every single time a new data point is put into the system. And you can actually put a lag into the system to see if this coefficient holds up or not. The package that we use for this is again from stats models, and you can get many of these details from many of the other models like ARIMA, RMAX, which we'll be looking on in just a few seconds. And these are, the more, I'd say, the more traditional methods that people use for, these kind of analysis. So yeah, this is an example for VIMA, and we'll just use that on the training set we have from Yahoo Finance on this SPY company. So let's run that and see what kind of results we're getting from this. So let's see, dependent variable D closed because we had put up for the closing value of this particular stock. Log likelihood, that is an extremely low negative number, which, it could be good, it could be bad, depending on the circumstance. If you're trying to sell or if you're trying to short or long the stock. So it's dependent on that. This particular result here is very similar to the kind of result you would get from a logistic regression test. So in a logistic regression test, you would have two possible outcomes for a particular data set, a 1 or a 0 in this case. And the system is basically telling you, what is the likelihood that the predicted value at a particular day is exactly what it was expected to be. Is it a 1 or a 0 in the same case? A 1 in this case representing that the predicted value was really close to the true value. If not, or if it deviated, then it's a complete 0. And of course, our approach here is to bring this to a value of p being less than 0.05. This is using a z-test, which is, again, common in statistics, but we can also change that to do like a normal Pearson correlation test instead. But yeah, that should be a good way of, seeing exactly whether or not your data is consistent in most ways. Another reason behind why we would do a normal ARIMA test is to confirm if the data set or the price information we have is linear or whether it is non-linear. If it is non-linear, you would be seeing these numbers, jumping pretty much anywhere and everywhere, which is problematic because in that case, the model buildup would be extremely complex. But that is the nature of most financial markets, and you will see most companies and price indices being extremely irregular in terms of their their movements. Any questions so far? Well, all right. I guess we can continue to move on with what we have so far. We have also now imported packages from the stats model for ARIMA, seasonal decomposition, which is another technique that is used for pricing analysis. And we're using the exact same thing to get information for another company, SPIN. This is a nice way of getting the information you want from one particular date to another particular date. But take note that some data sets may not have information in the same year, month, date format. They may have some other information along with it, and you may have to reformat and restructure the entire data set. So let's continue on, and let's just check the data set we have over here. So yeah, this is the closing price for a particular index, SPIN. And I can also represent this as a scatter plot to see exactly how dispersed the entire data set is. And I can also just put up a frequency plot to see how varied the entire data set is in terms of its values. So, that's just one way of looking at it. Now comes the good part. We will now be implementing a simple, how would I represent this in simple terms? A rolling mean and a rolling standard deviation method for comparing the prices to each other. So just to provide a bit of context, this is the data set we have right now, and we can see that the values are extremely irregular. Something interesting must have happened in the end of 2015 or maybe the beginning of 2016, where the prices just came swooping down. So this is an example of a non-linear pricing data set. And we can't exactly use more traditional methods for pricing analysis in this, but it's worth a shot to see exactly how well the prediction lies. So we then define a second function for creating a stationary value for the data set. And to provide a bit of context, what we're doing here is we're taking the values for each of the prices, we're calculating the mean and the standard deviation at each point, and we're performing an important financial test, which I'm sure a couple of people in the chat who have a history of finance would be familiar with. It's called the Dickey-Fuller test, which is to confirm the autocorrelation coefficient for the particular price in this case. We then take the results of the test, we append that to the data set itself, and then we can actually put that into the same chart to compare and see how well our model has performed on it. So let's just run that. And yeah, it seems like if we use the rolling mean method, we can get something that's quite close to the actual data set itself, but there tends to be a bit of deviation. So yellow line is the original data set, pricing information, and the red line is the rolling mean in this case. And the black line, the standard deviation, is put in to basically tell us what points a huge deviation has occurred. You can see that the standard deviation pretty much goes crazy in the exact same point over here because of how rapidly the prices have changed. So definitely something to consider when you do normal analyses like these. And this is one reason behind why LSTMs can be quite important, because they can capture these non-linear nuances in most cases. But again, you have to define and make the system extremely dense to capture these kind of things. And yeah, this is just a conclusion. After analyzing the above graph, you can see that the increasing mean and standard deviation, and hence our C is not stationary, which is an important conclusion. And these are the results of the Dickey-Fuller test. I would like to spend more time looking into each of these metrics individually, but given the time, I think it's much more important that we went forward with the entire session, and we can leave any questions for the end for now. So yeah, let's go to another form of a method called the seasonal decomposition method. There are a couple of models you can choose to work with, and also you can also work around with different metrics to see how well it performs, whether it is stationary, not stationary, linear, and nonlinear. What I would suggest to many people who would like to get into financial modeling with Python, please read the the product manuals, or even the package manuals, to better understand what you can change when you model these things. So let me just run this and see what kind of results I'm getting from this. So this is the observed result we have. This is the trend analysis after it's been decomposed. And what we're doing here in the second graph is basically removing the normal means from the the whole data set itself, which is an interesting way of representing the entire information. We can also take out all the seasonal deviations from the data set and the residual amounts as well. This is a really good example of a pre-processing step to do to your data before you start modeling on it. But in this case, we're doing this at the end because I clearly should have structured this notebook a bit better. But so just to repeat itself, steps like this come before the LSTM, because you want to remove any seasonal information or any deviations from the data set itself without losing its context. As we move on, we can also represent the moving average values from the modeling we've done so far. And you can see that, this should give you a bit of understanding as to which data points should be looked at with more attention because they may have higher deviations. And that is an extremely important thing to consider. And finally, we can also apply the same on a training and testing set over here. And let's run the Aviva model once again to see exactly how this works. So yeah, I've put up some comments here to provide better context. Maximum P and Q, these are parameters which are mathematical and statistical, which you would have to look into a bit more for research. M is another metric you can vary, which has to do with the frequency of the series. Then we have the D parametric, but in this case, we can just let the model do that. We're assuming there is no seasonality in the data set, and what that means is the data does not follow a typical, falling and rising trend as you would expect from most stock indices, which is true because if you look at the data, it's definitely not, not exactly as seasonal as you would expect. So let us run this data set once again. And yeah, we can now, take a look at the actual results of the Aviva model. What I would suggest is that once you have these informations, you basically should use a package like Pickle, and I think I can put up the link to that in the chat as well. Pickle would allow you to save these models onto your system with a PKL extension, and after that, you can basically load this for future analysis rather than having to have the system run on it every single time. Okay, then let's just run on the plot diagnostics of the Aviva model. And yeah, I'd say we've got a pretty good model. This is a normal Q to Q distribution plot. And the red line that represents the predicted value that the system is generating. So it's performing good in some ways, but it's only performing good because, this is a artificially generated data set. So on real data sets, there's going to be some amount of trouble as you come across. And we can just run the final few points in this notebook to see what we need. I can now take the fitted forecasts from these models and plot them at a 95% confidence interval. And let's just run the final analysis with all these model parameters we have. And yeah, this is an important graph because this is basically representing, the result of all this modeling that we've done with the traditional methods. We have the information of the training sets, the actual stock prices, and based on the seasonal decomposition methods, the Aviva models, and the RMAX models, the system is basically now telling us that, based on all this information in the past, it seems like this would be the direction of the stock in the future. And this shaded region over here, this represents, what we would refer to as the confidence interval in this case. And going back to the question about if we can use this for price modeling and actual stock investing, this is where the problem comes in. I can shorten this shaded region to make it more precise, but at the same time, if I do that, there is a chance that this predicted line, it would span in many separate directions. So there would be an equal distribution in each of those cases. So there is an equal amount of risk involved whenever you do these sort of modelings. But yes, with that, we've come across to the end of the LSTM and the traditional modeling in this case. The other file I did want to share with all of you was for the BTC pricing analysis. And this is a personal favorite of mine because it uses much more, many different columns rather than just the normal closing price. This too uses a much similar method for pricing analysis as the LSTMs. And what I would suggest to many people who do want to get into this, the better approach would be to start with smaller data sets and to work your way into something that's bigger and something more complex. normal Bitcoins and normal other cryptocurrencies, they have attracted a lot of interest, and people do think that you can throw in your money in these things and you can predict their futures with a good accuracy. But there's a lot of risk involved as well to it. These the code in this notebook uses pretty much the same techniques as we went on in the pricing analysis notebook. The only difference is that we're now coding for many different columns in this case. And you're using the exact same techniques: rolling means, rolling standard deviations. Some of these techniques work, some of these may yield more inaccurate results, but if nothing else works, you can always go back to the LSTMs, you can fine tune those, and you can see exactly how well they work then. And with that, I guess we have come to the end of this discussion. I realize we still have like 10 minutes to go with, and we can spend some more time on this if people have questions. So yeah, let's open up the floor for any questions and doubts people may have.
Yeah, I have a question regarding the Bitcoin price analysis.
Correct, yeah, okay.
So is LSTM is good for predicting Bitcoin price for volatile time, or is it good for quiet time, like normal, when the Bitcoin price is average 1,000, 2,000, not like 20,000 or 20,000 plus, something like that?
Now, many analysts would tell you that it's good to be used in both cases, even when it's high and when it's low. And I personally have a bit of disagreement with that, because unlike other kinds of stock indices, BTC can increase rapidly and drop rapidly. I mean, this was standing at like $3,000 back in 2019 or 18, and it's at 30,000 now, isn't it? It's that high. So
extremely volatile.
Yeah, it's extremely volatile. So it's better to do these kind of analysis when there's a low risk involved. So that would be when it's at low priced, I'd say. And at high prices, there's always that risk that you may put in too much money into these things, and well, there could be losses. So definitely at low prices, I'd say. That answers your question.
Is there any till now, I don't know about it, because that's why I'm just asking, is there any model has been established for those kind of volatile price analysis with machine learning?
Yeah, I mean, you'll find many examples of people online who have their own GitHub repos, and they basically put up their own models into this. The problem, of course, is that because this is a data set that is always being updated and there's always new information coming in, those models, they tend to lose their significance as time goes on, basically.
I see. Thank you.
Is it somehow possible to incorporate in this kind of model some special events, like, for example, the COVID pandemic, that the prices will drop or somehow, or it's just possible really to incorporate prices for training model?
That would be possible, and there is a good list of steps you would have to go through to accomplish that. You would have to rescale the data, and you have to format it in a way that you can account for those kinds of incidents and circumstances. So yeah, it is definitely possible, I'd say. Yeah. And yes, pre-processing, this is something I should have mentioned in the beginning of the session. Cleaning up your data is extremely important, because the columns have their own units, and it really helps to rescale this to a dimension between zeros and ones, or even -1 and 1, because that makes it less computationally expensive to the system, and you end up wasting less money on machine learning resources then. So always clean and rescale. Yeah.
Sorry, I have another question regarding that you started mentioning that about dimensionality reduction. So whenever there are a lot of attributes. So in financial data analysis, which method actually are very popular and good to use?
So I'm sorry, just so that I can get your question correctly, you're talking about which methods are most popular when people do financial analysis.
No, for dimensionality reduction.
Oh,
I mean, which
dimension.
attributes? Yeah, which attributes are good for?
So for dimensionality reduction, you will not be looking at attributes, but you will simply put in all the different attributes you have, and the system will reformat that into a single dimension. So if you use something like a principal component analysis or the TSNE or the T-SNE plot, you would be able to do a lot of the dimensionality reduction. Yeah.
Yeah. Okay, thank you.
Are there any other doubts or questions?
Yes. So I've been using the library skTime, which allows scikit-learn models to be applied to time series. I was wondering if you've used that, or do you have any kind of suggestions if I should be using that or trying to implement things like sliding windows by myself, or should I use convenience libraries like skTime?
I'd say, experiment with pretty much everything that is out there, because you never really know what's going to be really that useful. And I say this because I've been extremely, I guess, ever since I started doing Python modeling, I was, sort of attached to using SciPy because it's a scientific package and it has most of the things you need. And then one day I realized, okay, you can't get everything done with it, so you got to expand your territory. That's a natural thing.
Thanks.
Question from Daniel Montilla. Do you recommend any courses to be able to start working? Okay, so there are introductory courses to financial modeling using Python from the cognitive classes from IBM and even from the CPI Institute. And if you are, I could recommend a couple of books, which are actually a lot more useful in this case, because you actually end up practicing a lot of the stuff that's in there rather than simply getting the code from some website and just running it instead. So I'm gonna put maybe a couple of these book resources in the chats so that after the session's done, so that people can try them out. But yeah. And anybody else has any questions? I realize this is a lot to take in a single-hour session, but
I also want to ask, using the financial modeling, is there any, of course, it might be popular or more accurate with certain tools and instruments. Is there any tools or instruments you are bound to get a high precision or accuracy?
That is, I mean, it's a really strange. I wouldn't exactly say it's difficult to answer that question. It's just that depending upon the metric that you want to work with and going with the precision, for example, the best tools I can think about right now would be the typical LSTMs, that many different companies use, even the normal VAEs and the GANs, which are the autoencoders and the general adversarial network. So those would be the best, kind of models to work with. But again, these are foundational models, and you still need to train your data onto the models themselves. So, depending upon what kind of index or company or even, currency or cryptocurrency you're targeting, you will have to find that specific model to use and apply, basically. So, the answer to the question, is there the best model to work with? We know the answer. The problem is there's no single model that can do this for all kinds of price indexes and, companies. So yeah, does that answer your question?
Okay, thank you so much. Another base question I want to ask, with modeling, we know there are a lot of instruments to use, stochastic and stuff like that, especially Fibonacci, the golden mean rule, which has a lot of accuracy as well. Do you think Fibonacci can be tuned to adjust to financial modeling, or can you incorporate the two as one when using the financial modeling?
I mean, yes, you can definitely incorporate both of them, but you will definitely see there's a big difference in the kind of, results you get in terms of the accuracy. So it's probably better to stick with something that's more robust, is what I'm saying. You could definitely use Fibonacci, modeling for something like this, but as the complexity of the data becomes more, more complicated, you need advanced methods. That's ultimately the case. Okay.
Okay, thank you so much. Thank you. Yeah.
Just a question. Do you have any opinion on feedback loop? Like, agents will adapt based on the actions of other agents. In the long term, you basically create what complexity theory calls feedback loop. I don't know if you understand this, but it's basically like an agent will have an action, the other one will take an action based on this agent action, the other one. So basically, it's a feedback loop. So do you have an opinion about this on financial markets?
I do have an opinion. I mean, yes, I have worked with feedback loops in the past, and again, this is a question that goes back to the kind of person we're talking about in this case. If you are working in a company that has the resources and the time to do these recalculations for each of the nodes and to put this back into the system and to make those improvements, it's definitely a good process to go into, and it's much better than more typical LSTMs in most cases. But for the average individual who simply wants to do maybe like some small level analysis, it's really difficult to create those kind of systems, I think. So does that answer your question?
Yeah, it's. I was just thinking a little bit about that because sometimes I think that if there was like some kind of algorithm to deal with that or anything like that other than training, but basically are saying training more and more and more and using over time. Yeah. Thank you.
I mean, I would recommend maybe a software like MATLAB to do this, because you can actually visualize many of the feedback loops, and you can actually specify how you want the data set to be split every single time it's uploaded. And you can design this entirely on the Simulink platform, which is, it's intuitive, but again, it's it's the difficulty is that you need a student license to run it, and you don't expect the entire world to have that kind of information. What else was I going to say? As I had mentioned in the poster, I'll be selecting a few, I guess, lucky individuals who made it into the session today, and give them.
I would want to be part of it.
I mean, even if you don't get the book, don't feel disheartened. There will be other, resources that I'll be sharing once the session ends. Let me just reshare the.
Okay, but where can we get that? I mean, which Slack are you on? Which group Slack are you on? So we can.
I am okay. I'm not there specifically on any Slack groups. I guess in the general chat, or maybe SGAI.
Oh, general. Okay, SGAI. Yeah, I'm also over there. So.
To the individuals in the chat, if you could please just mention that you attended the session. I guess there's the survey link, where you can specify that this is the session you've been to, and you can add any specific information, I guess. Oh wait, no, sorry, that's the that's the docs file. I was looking at the drive. Oh, sorry, everybody, just give me a second. Yeah. Any other questions by any chance?
If you want to start the financial modeling as a newbie, basic, which steps will you outline for someone?
Sorry, could you just repeat that? Sorry.
I said if you are a newbie or you're starting financial modeling, will you recommend somebody taking a bit of finance courses or finance trading, then go into financial modeling, or the two are not interlinked? You could just take whichever route you want to do, then
I would
start
actually say, and this may seem like a bit of a strange answer, I'd say it's better that you start with statistics first, because
statistics. Okay.
yeah, because many of the techniques you end up using for analysis just comes from statistics, and it becomes the holy grail for pretty much anything and everything else. I would suggest, and this is if you really are passionate about doing financial analysis, there is a master's program in financial engineering from the World Quant University, which goes for 2 years. It's available for free online, and it doesn't exactly have any other costs associated with it. There's only an entrance exam to it, which is a bit difficult, but it's really good if you want to learn a bit more about financial analysis. And I think I can actually put that link up in the Daniel Montilla, did you do that, Master? No, I did not get to do the chance to get into that yet. I mean, I should have mentioned this in the beginning. I'm actually a chemical engineering student, but I do plan on taking up the master's at some point. What was the name of the course? It's the Masters in Financial Engineering from the World Quant University. Let me just put up the link in the chat. In the meantime, if anybody has any questions, do let me know, please.
Okay.
And I also posted a link to the survey link, which you should be, okay, yeah, that's the link in the chat, wqu.org.apply. Another question from Daniel. What's your opinion about high-speed trading? Oh, okay, this is, I feel like we're jumping into a bit of a controversial territory over here. There are companies that have been known to engage in a lot of insider trading whenever they get their hands on something that robust, but I mean, there are ways to build models for high-speed trading, and you can engage in them if you have like small amounts of money to dispense. But if you are in a position where there's a good chance that you might be working with a lot of money, it's definitely extremely risky to work with. But if you want to just work on models, there are a lot of models online that you can find for high-speed trading. Let me just put up the link for the Google form again, in case if anybody missed it. And we will close this at 5:10, which is officially university time, since most classes start 10 minutes late already. So I guess that's completely all right. But just to get a bit of a pulse check from everybody, how did everybody find the session to be so far?
Really, was lovely.
I understand it was definitely a little bit fast-paced, and thank you for the comments. Sorry, Daniel Montilla, you named an IBM course. Do you know the name? Yes, let me put up the link. This is from cognitive classes again. I realize I'll have to put these links all over again in the chat because everybody's comments are just like sweeping my comments in the chat. But don't worry, I'll be putting this in the chat once again. And
yeah.
Cognitive classes, yeah, that's the one. Sorry, what was I saying? Yes, so the session is definitely a bit fast-paced because we only have an hour to work with, but there's definitely a lot of good resources to get your feet wet into this topic. And it's definitely not as complex as people would like to say it is. This is coming from a person who didn't know much about finance maybe 2-3 years ago and just got into it after he found it to be interesting. Yeah. Thank you so much for the comments, Alex. I hope if anybody doesn't find their way through the notebooks, do feel free to ping me, and I guess I'll be deciding on my list of winners at some point. But to those who don't feel too disheartened if you don't get your names out. There'll be more resources to put in for everybody else. Okay. As we close out, do we have any final questions, comments, anything anybody would like to share, perhaps?
Just a little bit of thing to share. It's gonna be fun to see the coming years because we are in a situation of very low interest rates, and as soon as we get higher interest rates, the market will have probably will fall very slowly compared to the current way that it fell, like it was very rapidly. So it's gonna be fun to see the way that the algorithms will behave this how can I say, this fall. The way that the market will probably fall in the probably next decade or something like that. It's just a matter of time of the interest rates will increase probably.
I mean, that is an important point because we are in a world right now where most currencies are fiat currencies. So, pretty much play around with the interest rates in any way they want, which is, in some ways, it has its uses and advantages, but otherwise, it's extremely manipulative. There's another concern that in the future you would find a lot of different governments putting up litigation against the use of certain algorithms from people themselves, and that could become quite troublesome because it can happen, because somebody would say, oh, you can't exactly use LSTMs because anybody and everybody can just tap into the market. So, only some people could use it, or even some people who work in hedge funds where the big companies can use it. That can always happen. Can one use Forex data to predict future trends in the Forex market? That is, and I'm just trying to think about this from the perspective of foreign exchange, because it depends a lot more on the currency pair that you work with. I've usually heard people say that it's really much more better to model between maybe, say, Asian currencies, maybe like the Chinese yen versus the US dollar, when compared to currencies that may belong to the same continent. I'm not sure what the methodology is behind this, but I think it has to do something with the fact that there are some opportunities to, short sell between two different markets at different times if they have a big difference between them. So you can definitely use Forex data to predict future trends. Again, comes with its risks, and you have to take those risks into account. But always, 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 go back to the drawing board and understand that there's always equal opportunities for things to go bad and wrong, and even better. That's all I'm going to say. And we are 12 minutes above the mark now. Does anybody have one final parting thought?
Just wanna ask, when you're doing financial modeling, according to experts anyway, you are in the finance field more than us. They said it's also best to also trade or do your financial modeling on time trade or time slot, because in terms of like Asia, when the market opens, for instance, from 12 midnight, that's when parts of Asia like Japanese and Aussie and stuff like that is good to trade. But then when it's London time and New York session overlap, that's when you have to trade around volatility. I don't know how true that is. If you can maybe throw some bit of light on that.
I mean, it is true that there's only a short window with which you can actually trade with the stuff. Markets, they open up at certain times, they close at certain times. And this is one reason behind why you see a lot of arbitrageurs and a lot of short sellers who do this between different currency pairs, especially with the Asian currencies and the US dollar, because of this this time difference itself. But governments themselves, they become really smart at this, and they come up with their own strategies to make sure that people don't abuse this sort of a system too much. So it's like that old joke in economics like two people going down a road, one person who's an economist, the other person is not an economist. The person who's not an economist tells his friend, look, there's a $10 bill on the floor. And the economist friend says, no, there is no $10 bill. The joke here being that if there is an opportunity for somebody to make money out of the market, chances are somebody's already made it. And that opportunity no longer exists. So, you know, there may be people who take advantage of the time differences between two different markets, but you know that it simply doesn't last too long. That's all I'm going to say. And yeah, I guess with that we will be closing up the session today.
Thank you so much. Very amazing, honestly. I've learned.
I apologize to any people who may be put off by the fact that I do speak a bit too much, or I ramble on for long, for a longer time. But thank you so much for being here. Thank you so much for your lovely questions. And yeah, I'll be sharing the rest of the links on the chat as well, and I guess pinging as many people as I can so that you can see it. And yeah, look for I guess everybody should be looking forward to my giveaways for the books as well. All right. Thank you so much, everybody.
Okay. All right, great. Thank you very much. Thank you. Great session.
Yeah.
Amardeep, I have advertised for you on 60-day Udacity for people to join, actually. So to come to this Zoom. So it's a plus for me. Don't forget.
Thank you. Thank you so much.
I've already tagged you anyway, so ahead of you.
All right. Thank you. Thank you so much for that. Thank you so much for that. All right. I'll be just staying here until everybody leaves, I guess, in case anybody has any remaining questions. But yeah, looking forward to any other stuff, by the way. Question about the giveaway. How do we know about the giveaway? I will be randomly selecting some people, and I guess I'll be pinging you once they get what they need. But for the rest of you, do not be disheartened. There will be another giveaway, I guess, for another financial book, which you will definitely find interesting. So yeah.
One question, Amar, have you got any like a blog or a Slack link that you actually, present this, or are you in a financial group or Telegram? Asking for some of us who will be interested to tag you or follow you or to join some important financial groups.
I mean, I don't exactly have a blog, and I haven't written much about this thing, but I guess that would be an idea for the future. But thank you for I guess thank you for mentioning it. I guess you could still just keep in touch with me on Slack. I'm already there on the 60 Days Audacity group, the SGAI Finance group, and yeah, if there's anything else in the future, be sure to see that from me then.
All right. Okay. Thank you.
Can we connect with you on LinkedIn or something?
Yeah, good question.
I'm not sure if you would be interested in following a chemical engineer on LinkedIn, but yeah, I can just drop that in, I guess, on the chat. And yeah, in case the other way of getting your feet wet into these kind of topics is to just go for competitions as well. There's always a new competition for financial analysis happening every single month, and it's good to connect with people from all over the world to work on these kinds of things. Maybe your models work, maybe they don't work, but even if you can make money from financial modeling, you can make money by presenting it to companies, and they could give you some money. So
I might have a question if you take it.
sure, definitely.
Yeah. Like, how would you model like the change that happened in the GameStop stock, like would you include it for future predictions, or would you like remove the data from the, for example, the last week or the last 2 weeks, because it was something that was normal? So how would you deal with that?
This is, and I think everybody has their own opinions about the fiasco that happened with GameStop. What I would say is that it is good to put this into financial modeling, but if you look at the exact story behind how this happened, there is a bit of manipulation that happened on both ends. So
Yeah.
So it's much better to do these kind of analysis on stocks or even other kinds of companies where there is something of value to be created. And GameStop may have pushed off to such a high value right now, but how long can they sustain that? That's another question. And this is going to another principle from Benjamin Graham from The Intelligent Investor, which I will be sharing the link to the book. It's really good to read it. Rather than looking into companies from the perspective of the value they have, which could change every single day, you need to assess the value of the company and not the price. So that means you have to study the companies themselves, and you would have to convince yourself that this is a good company to put your money into. If you're the kind of a person who likes sustainability and you care for the future and the environment, you would be interested in companies that do biofuel generation, or maybe they create more efficient products, for example. That is their value, and their pricing may change every single day, but that isn't it's not reflective of the true value of the company.
Okay. Yeah, thanks. Thank you very much.
Okay. And a big thank you to Jaber for coming up with the idea for the drive as well. It wouldn't have been completely impossible without that. I saw you had a comment in the chat. You had a question you wanted to ask?
It's the question that I just asked. So,
oh, okay.
Yeah, that was me. Yeah.
I suppose somebody's waiting here for a question or something. Otherwise, we could just close it out right now. down to 3 people now. I guess I'll be closing it out. Thank you so much, everybody.